Hello and welcome to episode 389 of the Money to the Masses podcast with your resident expert, as always, Damien Fay and me, Andy Leakes. Damien, welcome back. How are you doing?
I'm good. I've been busy this week, actually, Andy. I've done quite a lot with national newspapers, people asking for comments about various different topics, from savings, in terms of savings rates. Actually, I talk about cash ladders on the podcast, and I've never done a video piece or an article on the principle, but I've finally done that. So if you want to find out what a cash savings ladder is and how you can use it to boost your interest rate now, there is an article on the Money to the Masses website which you can find by searching at the top in the search bar cash savings ladder, or you can look on our YouTube channel where I give a full explanation on there. But the other topic I was asked about by another national newspaper was investment platforms, best buy lists and portfolios, and how they'd been performing in this environment. So again, that's something interesting. But then leading on from that, we sometimes do reviews at the start of the podcast from listeners. So we got something slightly different this week because The Guardian actually reviewed us. So that was quite nice to see.
Yeah, that's right. We were mentioned in the best podcast of the week by The Guardian. The journalist Hannah Verdier provided a nice summary of a number of podcasts, and we were lucky enough to feature in that. And I'll just read out the write-up that we got in that. So it says, Money to the Masses. For a practical, tips-led podcast, financial whiz Damien Fay is your man. Fay, who left the city after he became, in his words, disillusioned with the way the public were left to fend for themselves because of the expense of financial advice, set up the website Money to the Masses to help demystify stocks and investment. The site's accompanying podcast now runs to nearly 400 episodes, with explainers aplenty on common scams, financial concepts, and the jargon that locks so many out of making the most of their money. So that was an article from The Guardian, podcast of the week. It's lovely to hear that.
I've been called a whiz, Andy. I'm almost blushing. If I wasn't so dark-skinned, you'd probably see. But I've been called a whiz. A whiz was quite nice. But it was nice for all the work we've done over the years to be picked up. And actually, in this podcast, I'm going to refer back to a podcast that we've done from 7 years ago. So it shows you how long we've been doing this. So we do try and keep the content evergreen so people can go and listen to back episodes. So that was really good to see. Don't forget, I'm doing a panel event on the 26th of October. So if you're listening to this podcast at the time it's published, then on Wednesday, I'm doing an event in the city which covers cost of living, retirement planning, and other topics. So if you do listen to the podcast, if nothing else, it would be nice for some people to come along, come and say hi, because I've not been out seeing people since before the pandemic, and we will eventually do another podcast meetup. But in the interim, if you are in the area on Wednesday evening, then you fancy coming to say hi, just to wave at me while I'm sitting in the chair, whatever you want to do, I don't mind, then we've put a link in the show notes through which you can reserve a place. So that'd be nice to see people.
Yeah, and just before we start and get on with what we're actually talking about this week, if you do want to review the podcast, then that would be fantastic. And if you want to take a leaf out of the Guardian's book and go down that route and call Damien a whiz, then that's completely up to you. Damien, so what have we got coming up on this week's show?
Sorry, Ed, when you started going down that road, I wonder what you're going to say. But on this week's show, we've got 3 pieces. So I've not done investing pieces for a couple of weeks. We had a bit of a time off from investing. I'm now come back with a bang, and there's 2 pieces on investing. So the first one, I want to talk about types of investment risk. And there's a reason why this came to the fore. And the other thing I want to talk about is something called the efficient frontier. So it sounds very Star Trekky, but the efficient frontier is something that is part of modern portfolio theory. And I want to explain what it is and why it's useful and what listeners can take away from it. And Andy, you're going to do a quick piece on the mini budget that isn't a mini budget, that I don't know what it is, U-turn that we've had in the last week. So we did a podcast episode recently explaining the impact of the now infamous mini budget. Now we have to therefore do the opposite of what's going on with the non-mini budget and U-turns and what's still there, and we'll have to do probably another update when we get another budget later in a couple of weeks. But just so people know what is going on, Andy's going to do a quick overview.
Yeah, that's right. And obviously, we're not a political podcast, so we're not going to go into the depths of what's been happening in terms of the politics of these things. So we're really just purely focusing on the finances and what it means for you. And it's been a crazy time. So let's get into it then. Obviously, we've got a newly appointed Chancellor of the Exchequer, Jeremy Hunt, and he came out and effectively reversed 95% of everything that was announced in the mini budget under Kwasi Kwarteng. So let's quickly look at what measures remain from that original mini budget. So the stamp duty thresholds that increased, and if you remember, they increased from 125,000 up to 250,000 before the first threshold of stamp duty starts being charged. That remains, partly because that had already been legislated for and it was already going through, so they couldn't really do much about it. But that's good news for house buyers and new buyers alike. And also the national insurance cut, the 1.25 percentage point rise that was introduced originally in April by previous Chancellor Rishi Sunak, that has indeed been scrapped and remains scrapped. And so from the 6th of November, that percentage point increase that I talked about to national insurance will actually be in effect reversed. And the only other thing to really survive from the original mini budget is a rule that capped the bonuses that wealthy bankers could earn, which was up to 200% of their annual salary, was scrapped originally by Kwasi Kwarteng. And while it was initially unsure on whether that actually remained or had been scrapped, for now the cap on bankers' bonuses has been scrapped. So they're the things that remained. Everything else has been thrown out. So let's just quickly go through that. The biggest one, and perhaps the biggest surprise, was the scaling back of the energy price guarantee. So if you'll remember, a few months ago now, Ofgem announced an 80% increase to the energy price cap, which meant that the average bill would go up to just over £3,500 per year. Government intervention was called for, and one of the first things that Liz Truss did as Prime Minister was guarantee energy bills would be capped at £2,500 for the average UK household for up to 2 years. And just to reiterate, that doesn't mean that everyone's guaranteed to only pay £2,500. It's actually a cap on the price per unit that effectively the government is going to pay on your behalf. It came in for quite a lot of criticism, even though it was generally a good thing because of the unknown costs. I mean, some were saying that it could even cost as much as 130 or 140 billion pounds, with no real clear plan on how that was to be repaid. Again, it caused a bit of turmoil in the markets, and Jeremy Hunt has since come out and said, right, it's still in place, let's get through the winter, but we're scaling it back. So rather than starting from the 1st of October and lasting for 2 years, it's now just going to last for 6 months. So it's a scaling back of that original plan. What's going to happen come April, we're not yet sure. Basically, there's going to be a Treasury-led review into how the government will provide support going forward for the people that really need it. So the likelihood is there will be further intervention, but probably and perhaps only for those that absolutely need it. We'll have to wait and see on that one. The next big announcement was the 1p cut in income tax that was announced under Kwasi Kwarteng that was going to be brought forward because it was originally going to come in 2024. He said, right, we're bringing it in 2023. Jeremy Hunt has now said that that's effectively been cancelled indefinitely. He said that while the government aims to proceed with cuts in due course, it will only take place when economic conditions allow for it and when that change is affordable. And so it basically means that the basic rate of income tax is going to remain at 20% going forward. The freeze on alcohol duty has been scrapped, which means that we'll probably see alcohol prices go up in the future. There were changes to IR35. Now, we covered that in the podcast briefly, but essentially that's special rules that are applied to certain workers in certain industries where they're paid not via payroll. Those rules were effectively relaxed under Kwasi Kwarteng. That's been scrapped and those rules are now back in place. There was a planned cut to dividends tax of 1.25%. That's now been scrapped. And just to finish off with this final summary of what remains and what's been scrapped, prior to this most recent announcement by Jeremy Hunt, Kwasi Kwarteng had already had to roll back a couple of things, which was one, the abolishment of the top rate of tax. You may remember that that was being abolished, the 45% additional rate of tax. That abolishment had already been scrapped and so reversed. And finally, there was that U-turn on corporation tax. There was plans to scrap the rise in corporation corporation tax, and that's the tax that companies pay on their profits. It was meant to be rising from 19% to 25% in April 2023. Kwasi Kwarteng, under his mini budget, said, no, we're not going to do that, but since came out and said, no, we're going ahead with that. So corporation tax is to rise from 19 to 25% in April 2023 as originally planned. I said it was a quick piece, Damien. It turned out to be a longer piece than I'd anticipated, but yeah, it's worth getting this nailed down. That's where we're at.
So you've done well there, Andy, because you made sense of something that is almost incomprehensible, that where we are, we're either in, out, who knows, and it will probably all change again in the next couple of weeks. So now moving on to the investment pieces that I want to talk about. I'm going to talk about types of investment risk. Now, I've touched upon odd bits of this in the past, but never pulled it together in a single piece. And there's many of these investment risks that I've not talked about before. So it's time that I did pull it together. And now, this partly was inspired by property funds. So if you go back to episode 249 of this podcast, I talked about property funds, the dangers and things to look out for. And at the moment, we are seeing, once again, property unit trusts gating. Now, what that means, there are a number of unit trust funds. So that's a type of fund that you might investing in your pension, for example, and they invest in property. So we're talking about things like commercial property, bricks and mortar. So some of the office blocks you guys might work in are likely owned by some of these big property funds. And what's happened with the rise in interest rates within the economy and the threat of recession, it's caused concern over that element of the property market. And so there's been a rush of investors trying to pull money out of some of these funds. And now it is down to the structure of these funds, because they're not investment trusts or ETFs. It's the unit trust in particular where this is an issue. Because of their structure, they are open-ended funds, and what that means is that the manager runs the portfolio of money, so we're talking about millions or billions of pounds, which is invested in buildings, for example, and there will be cash as well within that portfolio. If somebody wants to sell out that fund, what they do is the manager effectively gives them back their money by destroying the units that they have. So the manager will ensure that people get their money back. If someone wants to invest in the fund, they create new units, hence a unit trust, and the person's money is added to the fund, which is then ultimately invested in the assets in accordance with the mandate of the fund. Now, the issue is that if too many people try and pull their money out at once, then the fund doesn't have enough cash liquidity to be able to fund all of those withdrawals, and they're left with these properties that they are going to have to potentially sell in a fire sale, because you can't sell part of a building. And that is a problem. And to stop that, and to stop the people who remain in the fund being penalised, they gate the fund, effectively close it for a period of time. And that's what we're seeing more and more funds doing. So that is a risk. And it's one of the reasons why I don't cover those unit trusts that invest in property directly on 80/20 Investor anymore, because of this risk. We've seen it happen after Brexit, we've seen it happen during the pandemic, and we're seeing it happen again now we're hitting the economic buffers in the UK. So that is called a liquidity risk, because the risk that you can't get your money back from an investment because there isn't enough liquidity in that particular investment. So that got me thinking, what about risk and the types of risk that people should be looking for in their portfolios in any environment, not just this one? And liquidity risk is one of them. So for example, like I said there, if you want to invest in property, you might want to invest in investment trusts or ETFs that may invest in retail property, for example, even buildings, because the way they function is different. You buy and sell shares in those investment trusts, and they effectively work as a company that invests in those assets. So when you buy and sell shares, they're done on the stock market. It doesn't force the manager to sell the assets. Or you might use unit trust, but you invest in funds that don't buy actual property, but invest in shares of companies that are involved in the property market. That's another route. So investment risk is important, but there are lots of different types. Now, before I tell you about a range of them to look for in your portfolios, if you go back to episode 58, which is the episode that I talked about that was from 7 years ago, I talked about how to work out your own risk profile. That's a slightly different thing I'm talking about, but what that means is that if you're an investor, you should be able to work out, or you should know your risk profile, so you understand the kind of assets that you're comfortable investing in. And now one way of doing that is to use something like a robo-advisor, so things like Nutmeg, etc., which do questionnaires and then recommend portfolios for you, which will give you an insight into the kind of risk level you are comfortable with. or you can do something that's much more in depth, which is what the industry, so if you went to a financial advisory firm, they might use a company like Phenometrica, and you can pay for a one-off risk profiling assessment. And I talk about it in that podcast. Go back and listen to it. The link is slightly different to what I said in the podcast, actually, because they've changed their website. But you go to riskprofiling.com/get-started/my risk tolerance, and you'll find all the information there. The other podcast I listen to is Risk versus Volatility, which is episode 359, where I talk about the difference between risk and volatility. They are different things, although they're often used interchangeably, but they are different. So, types of risk. Now, there are broadly two categories of risk. There's systematic, which you could call market risks, and there are unsystematic risks, which are more idiosyncratic, and they tend to be more specific to sectors or individual companies if you invest in them. With unsystematic risks, you are usually able to mitigate or reduce them by diversifying your portfolio. And that means investing in a broader range of assets, different types of assets. So what I'm going to do is run through and explain some of these risks and see if you can keep an eye out for them in your own portfolio. So let's give an example. First one, equity risk. Now, equity risk is pretty straightforward. So if you invest in equities, there is a chance you could lose significant amount of money, but equally you can make money as well. Obviously, you can mitigate that risk by investing in a basket of shares rather than just an individual share, because then you're just pinning all your hopes on the outcome of one company. Or you can invest in a fund which diversifies much more widely by investing in lots of different companies. But in this instance, when I mention equity risk, it really refers to that broad market risk. So when you get an equity crash like we've seen this year, there is really no hiding place. And that is the kind of thing you saw in the financial crisis and the pandemic. Almost no matter what equity you invested in, which shares or which company, you would have lost money. That's equity risk. And there's very little you can do to diversify away from that. Leading on from that is interest rate risk. So there are risks that come from movements in interest rates. So what is good about 2022 is you've seen a lot of these risks play out in real time. So yes, it might not be very nice to see, but you are learning a lot about investing for the future. So make sure you learn those lessons and don't forget them. Interest rate risk, you're seeing that now. With rates rising, so that could be from central banks, it can also be the rates you're seeing on things like gilts. You're seeing the impact that's happening. And that is particularly prevalent in bonds. So as we talk about on the podcast, when interest rates rise, it tends to be bad for bonds, which means that they tend to fall. Bonds have done terribly in 2022. In fact, if you invested in bonds rather than equities, you would have done far worse. So if you picked a broad, say, UK gilt fund, that is down more than 20% year to date. So actually down way more than if you invested in the FTSE 100, for example. So there is an interest rate risk that will hit a portfolio, particularly the bond element of your portfolio, if rates start to rise. And that risk, again, is something that is difficult to mitigate, but it is possible. One of the ways to do that is to invest in different types of assets, i.e. cash. That's one way you could do that, because as rates rise, you start to benefit from better rates on savings accounts. And these are things that you learn over time, and I've been doing in my 80-20 portfolio, for example. Currency risk is another one. So we've seen that in the last couple of weeks in great detail. So we've seen the pound plummet over 2022, but in the last few weeks, we've seen it plummet down to all-time lows against the US dollar, for example. Now, of course, if you hold certain assets, then that currency risk can be a positive. Like if you've held overseas assets in the last month, you would have got a currency boost, because the overseas assets that you bought previously, when you convert the value of them back into a pound, which is now weaker, it'd be worth more pounds. So you actually would have had a currency kicker. But if the pound strengthens, which it has done at various periods in the last year, you will notice that it will hurt a portfolio that's invested overseas. You don't have so much of that risk if you invest in UK assets. So look at your portfolio. Where are the currency risks? Some funds will hedge out currency risk. So that means that they will put in place certain financial instruments that will make sure you aren't exposed to the ups and downs in markets. Let's say, for example, you invested in gold. It will just track the gold price if it was an ETF and not be influenced by the movements in the pound versus the dollar, for example. Now, another risk is credit risk. So this is something that can be a more broader market risk that can happen, but it tends to be, I think, often more an unsystematic risk. So one that is more niche towards a particular investment. But credit risk is the risk that there's going to be a default, particularly if you look at bonds. So let's say you invested in a bond from a particular company, so a corporate bond. There is a risk that you won't get paid back your money at the end, because don't forget, a bond is effectively a loan. So you get a coupon or interest payment. That's the return for you lending money to the company effectively. But will you get those payments or your money back at the end of the term? That's a key consideration, and that's called a credit risk. And bonds are graded. They're given gradings to assess that risk. So it's like an alphabetical grading, with government bonds from certain governments being at the top of the tree. So you might get AAA graded bonds, which show that a country is credit worthy, that they're going to pay back. Or at the other end, you get high yield bonds, which means there is a greater credit risk. And credit risk is often reflected in that yield. So the higher the yield, therefore usually the higher the credit risk. And that's because you need to be paid more compensation for giving your money to a company or a country. Now, of course, companies and countries can be downgraded on their rating in terms of credit risk. That has happened. It's happened to the UK. And so it's something to be aware of. So there are credit risks within your portfolio. Your high yield bond fund, for example, will be taking more credit risk because that's how it's generating those extra yields. Reinvestment risk is another systematic risk. That is the risk that when you reinvest your money, that you may get a worse interest rate or return on your money than you had done before. So it's a slightly odd one, but it technically is true. One way of thinking about it, I mentioned cash ladders in previous episodes of the podcast. You imagine when you get the money out of a maturing savings account and you invest it into another longer term one, that whole process runs the risk that the interest rates start to drop over time. So you actually, when your money matures, you get a worse interest rate when you go to reinvest that money in a savings account, for example. You would have been better off with hindsight just locking it away at the beginning. Now, we'll put a link to cash ladders if you want to find out more. Like I've said, I've done a YouTube video as well. Country risk is another one. So there are country specific risks. You can understand that if you look at the world and the issues that are going on. There can be things to do with the finances of countries as well. So UK has a very country specific risk at the moment because of what's been going on as a result of the mini budget. So you've got another great example how country risk can change as well. So anything associated with the UK for a period of time has been slightly tarnished. And you've got socio-political risk. So that is something that you can see widespread. You get geopolitical risks, you get wars in Ukraine, for example. All of these things can be risks that come along that sometimes are hard to mitigate. Now, some of those risks I've listed, which are mostly systematic risks, can bleed over into the unsystematic ones where they can be a little bit more idiosyncratic, and that's particularly with credit risk. Now, counterparty risk is another one. So counterparty risk is a bit more nuanced and it normally relates more to a particular investment. To give you an example, when Lehman's crashed, when we had the financial crisis, they were the counterparty to certain investments. And so you might have heard of structured products, which are a type of investment that try and give people their cake and eat it. So it might be a product that will say give you a certain upside of the FTSE 100, but will guarantee that if the FTSE 100 falls by a certain amount, that you won't lose any more than a certain level of money. So you're getting exposure to, say, a FTSE 100 index, but you're not getting all the upside, but it's limiting the downside. So you can create a product like that, and they do that, and it's very opaque in terms of charging. I'm not a fan of them, to be honest, but they are prevalent, and people often become attracted to them, and they are often sold by banks. You'll see them advertised to investors. Now, to make that magic box work, to provide the guarantee and to make the whole thing work, they have to use financial instruments that are backed by somebody else, and that's the counterparty. And so there is a risk if that person somehow can't live up to the promise, then effectively your investment will blow up. And we saw that in the past. So counterparty risk is something most people don't realise, that you've got to dig beneath the curtain. Look how the lady's been sawn in half and how it works. What's the magic? And you'll work out there's something in there that if it goes wrong, then the whole magic trick breaks. That's what counterparty risk is. So look for counterparty risk, especially if you're buying a complicated product. that has guarantees in it, because there will be a counterparty risk. So work out, where does the risk lie? Who has to go bust for this to blow up for you? Other risks that exist that could be company specific are things like regulatory risks. So you might see an industry, for example, they come along and there's a regulation put in place that can just destroy an entire industry overnight because they might ban something. And that's happened in the past, where you get whole industries wiped out by a change in regulation that might outlaw something in particular, and you can therefore no longer do it and sell something maybe in the UK. Another risk is information risk. Information risk is the risk that the information you've got is flawed. And so that might be, for example, you invest in a fund and you don't know all the nuances of the investments that fund might invest in, and the fund might be taking risks you don't know about, and then it blows up. We've seen that in the past where people didn't have all of the information they felt they should have had. I'm not going to name any names on that one. There are some risks that are much more personal and specific to the individual. So that's horizon risk is one. So that is the risk that your time horizon might change. And so that could be an event comes along in your life that might cause your investment horizon to shift. So that could be a redundancy, for example. So you can no longer fund your investments or your pensions to the level you wanted. So your investment time frame is going to have to alter to allow for that. Longevity risk, which is a risk where you could outlive your investments, for example. And finally, this is a big one, concentration risk. And concentration risk is where you have too much of your investments concentrated in a particular area. It could be a company, it could be a sector, it could be a particular asset or collection of assets. So you only have, for example, bonds and equities. So you get these risks. So the message of this part of the podcast, look for those risks within your own portfolio. You cannot mitigate all of them. You shouldn't be up all night worrying about every single one. But if you are aware of them, then you can mitigate as much as possible. And the ones that you can't control, then they are almost part of the investing process. And so, for example, the equity risk, that is something that is part of investing in equities. So look for those risks, see if you can mitigate any of them. Look where the blind spots are, because one of the things when I invest is I always look at what the potential risk is. Focus on risk rather than the return, and hopefully the return will take care of itself. Now, on 80/20 Investor, I run a 50k portfolio, and my portfolio is down around 6% year to date. You compare that to portfolios that have got similar equity contents, and you're talking about they're down 12 to 14% year to date. And I'm talking about even the most popular multi-asset funds out there. And the reason I've been able to avoid some of that is because of that diversification element, which has removed some of that equity risk. So I don't have excessive equity risk, and part of my portfolio does actually bet against equities. And I don't have a significant bond exposure at the moment, which has reduced my interest rate risk. But of course, conversely, I'm well aware that if bonds suddenly rally, there is the risk that my portfolio will be left behind. So keep an eye what the risks are and manage them accordingly.
Okay, so it's a double investing special this week. You mentioned it at the start of the podcast, the Efficient Frontier. It's nothing to do with Star Trek. What have we got?
So the Efficient Frontier is something that's at the heart of modern portfolio theory, and it really relates to buy and hold investment strategies, which a lot of people obviously do. So they'll buy something and keep it for the long term. Now, what the Efficient Frontier does is show you the best rate of return you can expect from a portfolio given the level of risk that you're willing to accept. And you might see different versions that say volatility, but it's the risk versus the expected return. And the way to understand this is to visualize it graphically, because it is a graph. So imagine in your head, as I'm talking to you, you've got an axis, you've got an x-axis, so the horizontal axis that is risk. So the further you go along to the right, the higher the risk you are taking. Then the vertical axis, the y-axis, is the expected rate of return. Now, in an ordinary world, people might think that if you build a portfolio that's 100% bonds, if I said to you, where does that sit in that chart? You would hopefully go, well, bonds are low risk and my expected rate of return would be pretty low. So you're going to put it in the bottom left-hand corner of that chart that I've just described. If I said to you, right, now put a dot on that chart where a portfolio that's 100% equities, where does that sit? Hopefully you're going to put it somewhere in the top right, because you're going to say, well, it's a higher risk and I'm going to expect a higher rate of return. And then logically what people would do is draw a line between those two that says, right, okay, as I increase my equity content, my risk level goes up and my expected rate of return goes up as a diagonal line. And that would logically make sense. What they found, though, is that this doesn't strictly hold true. If you were to plot all of the different variants of portfolios out there, and I was to say to people, go and create lots of portfolios, bond and equity mixes with different equities and bonds in them, and plot them on this chart, they would be lots of dots all over it. But what you would find is that there is this efficient frontier that exists. So there is a line that you can draw that all of the portfolios will be below. That's because they will make less return for the level of risk you're taking. So I'm aiming for the optimum, if that makes sense. Now, it isn't that diagonal line that you were thinking. What they found is that actually what occurs is that when you start with 100% bonds and you start to increase your equity content, you actually reduce your level of risk that you're taking, and the expected rate of return starts to go up. So while the second fact you would obviously assume is true because you're taking more equity risk, so you're thinking, yep, my expected rate of return is going up, but adding some equity content starts to reduce the risk of your portfolio. And that continues to be true to a certain point. Now, visualize that chart again, that axis, with risk along the bottom, expected return on the vertical. Rather than having that diagonal line from bottom left to top right, what you actually get is something that looks like the front nose of a plane pointing to the left-hand side. So it starts at 100% bonds, and as you increase the equity content, you start to draw effectively a nose cone of a plane going to the left, and then it goes off to the top right hand corner. And the tip of that nose cone is where you get a 25% equity and 75% bond portfolio. And that is a portfolio that seems to have an optimal rate of return for the risk that you're taking. Now, obviously, if you've been able to visualize this with me, then that nose cone that we've drawn, so we started with a 100% bond portfolio, that we then increased the equity content, which actually reduced the overall risk level of the portfolio and started to increase the overall return of the portfolio over the longer term. And we got to the nose cone of the plane. Then as you start to increase the equity content of that portfolio, once again, you actually start to increase the risk level. So that's where we start going over the top. And what you'll find if you visualize it, and I will put a chart in the notes on the website for this particular podcast, what you will find is you'll get to a point where you have a portfolio that has the same risk level as the 100% bond portfolio, but its rate of return over the long term is significantly higher because it's been optimized by having that bit of equity content. Then what happens as you keep adding equity content to your portfolio, you rapidly increase the risk profile, but the rate of return that you get doesn't increase in lockstep. So you're taking more risk for not much more return. Now, I'm not saying that people shouldn't be taking more investment risk. That's down to your individual profile and your views on investment markets. Because obviously, if you were young, for example, and you've got a very long investment time frame, then you'll be very happy taking a lot of investment risk. And you may invest in a tracker, for example, of one of the major equity indices, be happy with that because you've got a very long investment time frame and you're happy with the risk because you're after the return. What I'm talking about here is with the efficient frontier is trying to work out the optimum rate of return that you can get for a level of risk and what that portfolio is. Now, I thought I'd take that and run with it. And I applied it to the life strategy funds from Vanguard. Now, I don't like talking about Vanguard all the time because I know it's very popular, but they are just one fund house with this particular set of funds that are popular. And I know there's been a lot of criticism in our Facebook group about them at the moment. They were the darlings of everybody, but where people didn't realise the inherent risks that were in those funds, which are some of the risks that I talked about in the last piece on the podcast, they are sitting on losses year to date. For example, the 100% equity version of the Life Strategy Fund is down over 9% year to date, whereas you go all the way down to the 20% equity version, which is down 17.8% year to date. And obviously you've got the range between those with the different variations of the life strategy funds. But I thought, well, what is the optimum if we're going to apply this efficient frontier idea to something like these funds? And what I found, if I looked at 2022 and then did it over a longer period of time to 10 years, then the most efficient version was somewhere between a 30% equity holding and a 40% equity holding. So that's interesting. It's still got a significant bond exposure. It also ties up with the findings of the efficient frontier analysis that I talked about earlier, where the most efficient portfolio had a 25% equity exposure and a 75% bond exposure. So the optimum life strategy seemed to be somewhere around about the 30% equity exposure, as I said. Now, obviously, bearing in mind the figures that I mentioned for year to date on those funds, then you would have still been sitting on heavy losses. But that isn't what the efficient frontier is doing. It's saying for the risk you're taking, what's the portfolio to get the optimum balance of risk versus return? And that's what it's told you. But of course, 2022 is an example of where you get those very high risks in bonds, for example. So the 100% bond portfolio has done dismally year to date. If you had a gilt fund, for example, then you'd be sitting on losses way in excess of 20%, which just goes to reaffirm what the efficient frontier shows, that having just a bond portfolio is risky and having some equity content in there too. And so the other takeaway from this is that while people will invest as they see fit, what the efficient frontier perhaps gives some people a shred of comfort is that even if they invested in a bond-heavy portfolio, then 2022 is an anomaly. It is a almost once in 100-year event that we're seeing with the bond market. But it also shows that they would take in perhaps an optimum strategy if they had around about 25-30% in bonds for the risk-return profile. Of course, that would suit somebody who had a much lower risk appetite. And it might encourage them to stick with investing. I know there'll be lots of people wanting to bail out. But this just shows you even the best analysis in the world would have been sitting on a heavy loss in 2022. Now, of course, don't forget you can mitigate some of this by investing in different assets. That could be cash, that could be commodities and other strategies, which is what I've done with my 50k portfolio on 80/20, which is why I've outperformed all of those life strategy funds this year. And I've been very mindful of that risk versus return profile. So as I said, I've put an image of the efficient frontier in the podcast notes on the website. And if you found this interesting in any way, then why not go and do your own research about the efficient frontier and see if there's any way you can apply it to what you're doing with your investments.
Okay, so that's it. We're done for this week. A couple of really interesting investing pieces there. I feel like we've missed out a bit in the last couple of weeks, and you've certainly made up for it. If there's anything you'd like Damien to cover in future episodes, feel free to get in touch or do get involved on the Money to the Masses community group. It's facebook.com/groups/money to the masses. And of course, don't forget, this is the last shout out now that we can do on the podcast to be able to get tickets to see Damien at a live panel event. We'll put details of that in the show notes so you can click on that and register your interest. So that's it. I think we're done for this week, Damien, aren't we?
Yeah, so that's it. Until next time.
Until next time.